On December 18th, 2024, something broke in the global financial system that most people will never hear about. Not a bank collapse, not a headline crash. Something quieter, something structural, a mechanical failure in the machinery that keeps international trade, currency flows, and sovereign debt moving. The kind of break that doesn't announce itself with sirens, but with silence, with withdrawal, with refusal. And by the time the media catches up, the damage will already be irreversible. Because what snapped wasn't a market, it was trust. And trust, once broken at the institutional level, doesn't heal, it metastasizes. Right now, across trading desks in London, Hong Kong, and New York, a very specific class of assets is being quietly refused. Not sold, refused. Counterparties are walking away. Collateral is being rejected. Settlement windows are stretching from days into weeks. And beneath all of it, there's a number growing in the shadows. $3 trillion. That's not the size of the loss. That's the size of the exposure no one wants to admit they're holding. This isn't a prediction. This is already happening. And the global market just snapped. Let's start with what actually broke. Not the narrative version, the mechanical version. In the modern financial system, there's a layer most people never see. It sits between central banks and commercial banks, between sovereign debt and private capital, between dollars and everything else. It's called the repo market. Repurchase agreements, short-term loans collateralized by government bonds, corporate debt, and increasingly synthetic instruments no one fully understands. This market moves roughly $4 trillion every single night in the United States alone. Globally, the number is closer to 12 trillion. It's the lubricant of the entire system. Without it, banks can't fund overnight operations. Hedge funds can't leverage. Corporations can't roll over short-term debt. And when it freezes, everything else does too. In September 2019, the repo market spiked violently. Overnight lending rates that should have been around 2% exploded to 10% in a matter of hours. The Federal Reserve had to inject hundreds of billions in emergency liquidity to prevent a cascade. That was a warning shot. What's happening now is different. It's not a rate spike, it's a refusal to transact. And that's worse. Because when rates spike, it means someone still wants the deal, they just want more compensation for risk. When counterparties refuse entirely, it means the risk is considered unquantifiable, unhedgeable, systemic. Here's what triggered it. Over the past 18 months, central banks across Europe and Asia have been quietly unwinding their holdings of U.S. Treasuries. Not because they wanted to, because they had to. Japan needed dollars to defend the yen. China needed dollars to stabilize capital flight. France needed dollars to manage energy import costs after the collapse of long-term Russian gas contracts. So they sold treasuries, hundreds of billions worth. And who bought them? Not other central banks, not pension funds, hedge funds, leveraged vehicles, entities that borrowed dollars at low rates, bought treasuries at higher yields and pocketed the spread. A classic carry trade. Except it only works when both the borrowing cost stays low and the collateral stays stable. Neither of those things is true anymore. The Fed held rates high for longer than the market expected, and treasury prices, which move inversely to yields, have been eroding. So now these hedge funds are sitting on collateral that's worth less than the loans they took out to buy it. Margin calls start, forced liquidations begin, and suddenly the very assets that are supposed to be the safest in the world, U.S. government bonds, are being dumped into a market with no natural buyers. That's the snap, not a crash, a liquidity extinction event. But it gets worse. Because treasuries aren't just investments, they're the collateral backbone of the entire global financial system. When a European bank wants to borrow dollars from a U.S. money market fund, it pledges treasuries. When a Japanese insurance company wants to hedge currency risk, it uses treasury futures. When an emerging market central bank wants to prove it has reserves, it points to its treasury holdings. So when treasuries stop being accepted as pristine collateral, when haircuts, the discounts applied to collateral value, start widening, the entire chain breaks. And that's exactly what's happening. Haircuts on even short-term treasuries have doubled in certain overnight lending facilities, tripled in some cross-border transactions. It's not official, it's not announced, but it's real and it's spreading. Now ask yourself this. If the safest asset in the world is being discounted, what happens to everything below it? Corporate bonds, mortgage-backed securities, emerging market debt, structured products, derivatives built on derivatives built on derivatives. The entire edifice rests on the assumption that at the bottom, there's something solid. U.S. Treasuries, the risk-free rate, the foundation, and that foundation just cracked. So where does the $3 trillion come from? It's not a single institution. It's not one trade. It's the cumulative notional exposure across a web of interconnected positions that all assume the same thing, that treasuries would remain liquid, that collateral could always be posted, that settlement would always clear. $3 trillion is the rough estimate, and it's conservative, of leveraged positions tied directly or indirectly to treasury collateral that are now underwater or approaching margin thresholds. Some of it is visible. hedge fund filings, dealer balance sheets, but most of it is hidden in the derivatives market, interest rate swaps, basis trades, curve steepeners. Total return swaps on bond indices. These instruments exist in the shadows, traded over the counter, cleared through central counterparties that themselves are levered. And all of them are built on the same implicit assumption, that U.S. government debt is money good, always, instantly, without question. Except now the question is being asked, and once it's asked, it can't be unasked. Because the moment a major counterparty, let's say a European bank, a Japanese pension fund, or a sovereign wealth fund, refuses to accept treasuries at par in a bilateral transaction, every other institution sees it, and they adjust, not publicly, not in press releases, but in the fine print, in the collateral schedules, in the legal terms buried in tri-party agreements. Haircuts widen, margin requirements increase, leverage gets cut, and positions that were profitable at 99 cents of collateral per dollar borrowed become insolvent at 95 cents. That's the cascade. And $3 trillion is simply the best guess at the size of the positions that can't survive that cascade. But here's the thing. No one actually knows the real number because the leverage is hidden, because the exposures are synthetic, because the same treasury bond can be pledged as collateral in 5 different transactions simultaneously through rehypothecation. So the $3 trillion might be conservative. It might be 5. It might be 8. And no one will know until the defaults start. This isn't a story about reckless traders or greedy bankers. It's a story about a system that was designed to break. The global financial system runs on a contradiction. It requires infinite liquidity and zero risk in the same instrument. U.S. Treasuries. They have to be perfectly safe so they can serve as collateral. But they also have to be perfectly liquid, so they can be sold instantly without loss. Those two things are incompatible in a rising rate environment. When the Fed raises rates, Treasury prices fall. That's math. But the system was built on the assumption that rates would stay low forever, that central banks would keep buying, that inflation was dead, that leverage was free. And for 15 years, from 2008 to 2023, that assumption held. But assumptions aren't physics, and physics doesn't negotiate. Here's the real problem. The only entity large enough to absorb this kind of dislocation is the Federal Reserve. They're the only buyer of last resort. The only institution that can print dollars without limit and buy treasuries without caring about the price. But they're trapped. If they step in now, if they restart quantitative easing, if they flood the system with liquidity to stop the cascade, they reignite inflation. The same inflation they just spent 3 years trying to kill. So they wait, they watch. They hope the market stabilizes on its own. But the market can't stabilize. Because the market isn't a natural system. It's a psychological one. And once confidence breaks, once the belief that treasuries are risk-free collateral breaks, no amount of job owning or forward guidance can fix it. Only money can. And the Fed doesn't want to print. Not yet. Not until something bigger breaks. Something public, something undeniable. So what happens next? The contagion spreads in predictable stages. First, hedge funds that can't meet margin calls start unwinding. Not strategically, desperately. They sell everything liquid. Equities, commodities, investment-grade corporate bonds, anything that can be converted to cash fast. That creates price dislocations in markets that have nothing to do with treasuries. A tech stock drops 5% in a day for no fundamental reason. A blue-chip corporate bond suddenly trades at a discount. Gold spikes, then crashes, then spikes again. Volatility becomes the only constant, and volatility is expensive. It destroys leverage. It forces de-risking. It turns every position into a potential liability. Stage 2 is the banks. Not the small ones, the big ones. The globally systemic institutions. They don't fail. They withdraw. They stop making markets. They stop offering repo. They stop accepting collateral from counterparties they don't fully trust. And trust in a liquidity crisis is measured in microseconds. One missed settlement, one delayed payment, one rumor of exposure. That's all it takes. And suddenly, the institution that was fine yesterday is untouchable today. Not because of fundamentals, because of perception. Because in a system built on leverage and overnight funding, perception is reality. If people believe you can't fund, you can't fund. It's a self-fulfilling prophecy. And the only defense is to pull back faster than everyone else, to hoard liquidity, to refuse transactions, to snap. Stage 3 is sovereigns. Governments that relied on cheap funding suddenly face higher borrowing costs. Not because their economies collapsed, because the collateral chain broke. A European country that could borrow at 2% 6 months ago now faces 4%, then 5%. Then the market simply closes. No bid, no auction, no buyers. And when a sovereign can't roll over its debt, when it can't fund its deficit, it has 2 choices, default or devalue. Neither is acceptable. So they do what all governments do in a crisis. They call the central bank. They demand intervention. They demand liquidity. And central banks, already trapped between inflation and deflation, between credibility and chaos, are forced to choose: print or collapse. There is no third option. Here's what makes this crisis different from 2008. In 2008, the break was visible. Lehman collapsed. AIG needed a bailout. Mortgage defaults spiked. People could see the problem. They could point to subprime loans, to housing prices, to derivatives. It was tangible. This time, the break is invisible. Treasuries are still trading. Banks are still open. Stock markets are near all-time highs in some sectors. To the average person, everything looks fine. And that's the illusion. Because the break isn't in prices, it's in plumbing. It's in the hidden machinery that allows prices to exist in the first place. It's in the willingness of counterparties to transact. And when that willingness evaporates, when institutions start refusing each other's collateral, the system doesn't crash. It freezes. And frozen markets are more dangerous than crashing ones. Because in a crash, at least there's a clearing price. In a freeze, there's nothing. No price discovery, no liquidity, no exit. The mainstream narrative will lag. Financial media will talk about volatility, about technical corrections, about profit-taking. They'll interview strategists who say it's a healthy pullback, a rotation, a normalization. And all of that will be true in a superficial sense. But it will miss the core. It will miss the fact that the collateral backbone of the global system is fracturing. That $3 trillion in leveraged exposure is sliding toward insolvency. That the only entities capable of stopping it are the same entities that caused it, central banks. And they're out of moves. They can print, but they've already printed. They can cut rates, but rates are still elevated. They can talk, but talk is cheap. And the market knows it. Let's run the numbers conservatively. $3 trillion in notional exposure. Assume an average leverage ratio of 10 to 1. That means $300 billion in actual equity at risk. Now assume a 20% markdown on Treasury collateral due to widening haircuts. That's $600 billion in margin calls. Most of that can't be met, so positions get liquidated. But liquidating $3 trillion in notional exposure doesn't happen cleanly. It happens in waves. The first wave hits the hedge funds. They're the most levered, the most exposed. They liquidate $1 trillion in positions over a few weeks. That floods the market. Prices drop further. Haircuts widen more. Now the second wave hits. The dealers, the market makers. The institutions that were providing liquidity suddenly need liquidity themselves. They pull back. Bid-ask spreads widen. Settlement times extend. And the third wave, the sovereigns and the central banks, realizes too late that the problem isn't solvable with traditional tools. Because the problem isn't a lack of money. It's a lack of trust. And trust can't be printed. Now let's go extreme. Assume the leverage is higher, 15 to 1, 20 to 1. That's not uncommon in the derivatives market. Suddenly the $300 billion in equity becomes $200 billion, $150 billion, and the margin calls double, triple. Positions that were supposed to be hedged turn out to be naked. Counterparties that were supposed to be solvent turn out to be shells, and the cascade accelerates. At that point, the $3 trillion isn't the problem, it's the trigger. The real problem is the $50 trillion in global derivatives tied to interest rates, the $150 trillion in total notional derivatives exposure across all asset classes. Because once the foundation cracks, everything built on top of it collapses. Not slowly, instantly, because modern finance operates at the speed of electrons. And electrons don't care about press releases or policy statements. They care about math, and the math just broke. So why does this matter to you? Because the window between recognition and reaction is closing. Right now, most institutions are in denial. They think this is temporary, a liquidity hiccup, a technical dysfunction. They think the Fed will step in, that central banks will coordinate, that somehow this will resolve without pain. But the math doesn't allow for that. The leverage doesn't allow for that. And the physics of a fractured collateral system doesn't allow for that. There's a reason the term snap is used. Because once a structural element snaps, it doesn't bend back, it breaks. And the system either adapts or collapses. Adaptation means repricing, it means defaults, it means institutions failing, it means wealth being destroyed, not slowly over years, but rapidly over months. And the people who understand this now, who see the hidden breaks, who recognize that treasuries are no longer risk-free collateral in practice, even if they are in theory, those people are moving. Not loudly, not publicly, but deliberately. They're reducing exposure, they're hoarding liquidity, they're avoiding the instruments tied to the $3 trillion hole. Because they know what's coming, not a crash, a restructuring, a repricing of risk across the entire system. And that repricing doesn't happen smoothly, it happens violently. Here's the final piece. The reason this is inevitable. Debt, at a certain scale, becomes a physics problem. When debt grows faster than the economy that supports it, when interest payments consume an increasing share of revenue, when the only way to service old debt is to issue new debt, you enter a terminal phase. Not tomorrow, not next year, but on a timeline measured in quarters, not decades. The United States, and by extension the global system that runs on dollars and treasuries, crossed that threshold quietly. Federal interest expense just exceeded $1 trillion annually. That's more than defense spending, more than Medicare, and it's growing. Not because of policy, because of math, because the debt compounds. And compounding is exponential. It doesn't care about politics. It doesn't care about innovation or productivity. It cares about the rate, and when the rate rises, the math accelerates. The $3 trillion crisis isn't a crisis of confidence. It's a crisis of arithmetic. And arithmetic doesn't negotiate. The system will respond. Central banks will eventually intervene. They'll print. They'll buy. They'll backstop. But the cost of that intervention is inflation, currency debasement, wealth transfer. And the people holding the wrong assets, the assets denominated in the currency being debased, will lose. Not because they made bad decisions, because the system was rigged from the start, built on the assumption that debt could grow forever. That leverage was free, that treasuries would always be accepted at par, and that assumption just shattered, quietly. On December 18th, when the global market snapped. This isn't speculation, this is observation. The repo haircuts are real, the refusals are real. The $3 trillion in exposure is a conservative estimate based on available data and reasonable assumptions about hidden leverage. What happens next isn't certain in its details, but it's certain in its direction. The system is deleveraging. And deleveraging, in a system this large, this interconnected, this dependent on collateral chains that stretch across borders and asset classes, isn't smooth. It's catastrophic. Not in the sense of immediate collapse, but in the sense of irreversible structural change. Institutions that were considered safe will be revealed as fragile. Assets that were considered liquid will freeze. And the narrative, the story markets tell themselves about stability and resilience, will break. It's already breaking. You just can't see it yet. Because it's happening in the plumbing, in the overnight markets, in the collateral schedules, and the refusals whispered between counterparties who don't trust each other anymore. But it's there, and it's growing. The math is already locked in. The leverage is already deployed. The collateral is already fractured. All that remains is time. Time for the positions to unwind. Time for the margin calls to cascade. Time for the system to realize that the foundation it was built on, the risk-free asset, the pristine collateral, the U.S. Treasury bond, isn't what it thought it was. Not because treasuries will default. They won't. The U.S. can always print dollars to pay dollar-denominated debt. But because in a rising rate environment, in a world where central banks are trapped between inflation and insolvency, treasuries are no longer the safe haven they were designed to be. They're just another asset, subject to price risk, subject to liquidity risk, subject to the same forces that govern everything else: supply and demand, fear and greed, trust and refusal. And right now, refusal is winning. So here's the question you need to answer for yourself. Not in the comments, not out loud, but internally with stakes attached. If the safest asset in the world is being quietly refused by institutions that have no choice but to be conservative, if $3 trillion in leveraged exposure is sliding toward insolvency, if the collateral chain that holds the global financial system together is fracturing in real time, what does that mean for the assets you hold, for the assumptions you've made, for the belief that this time, somehow, the system will stabilize without pain? Because the system doesn't stabilize, it snaps. And when it snaps, it doesn't ask permission, it doesn't send warnings, it just breaks. And by the time you see it in the headlines, by the time the media catches up, by the time the central banks admit there's a problem, the damage is done. The positions are liquidated, the losses are realized. The wealth is transferred, and the only question left is whether you saw it coming or whether you believed the illusion. The illusion that everything was fine, that treasuries were safe, that $3 trillion in hidden leverage didn't matter, that the global market hadn't already snapped. Physics doesn't negotiate, and the physics of this system just ran out of time. Now let me ask you something, and I want you to think carefully before you answer. Drop your response in the comments below. If the foundation of the global financial system, the one asset every other asset depends on, is being refused as collateral by the institutions that need it most, what do you think happens to everything built on top of it? Not what you hope happens, not what the experts say. What do you think actually happens when $3 trillion in leverage meets zero liquidity? Answer below. Because the math doesn't care what we believe. It only cares what's true, and the truth just broke.